Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation. Good morning. Welcome to the BOGART Effect. I have Alex Spencer with me today. And, Alex and I do a lot of talks together, usually not on camera.
So, yeah, this is one of the first ones here.
But we're going to talk a little bit about election and politics. Very timely conversation right now going into the November elections. And this is one where I feel investors get very heavily impacted by elections and specifically what the outcome of the November election will do to the markets and how it would impact their portfolio. I just wanted to spend a little bit of time having a conversation around what are some of the things that we think are driving that, what we think are ultimately going to happen with regards to the markets, and then really a narrative around investment strategy, right? So Let's talk about the emotional side of this, right? And how that impacts investor behavior specifically.
Well, first off, you're 100% right. Coming into 2024, it was all about, this is an election year, right? You heard that a lot. What's going to happen with markets? What volatility can we expect? And lo and behold, what an election cycle it's been already so far, given the past couple months.
Historic events.
Exactly. I had to get up and just make sure that it was still, in fact, Kamala Harris and Donald Trump.
Yep.
Politics and investing, we have to first understand that they're fundamentally two different animals, right? With politics, we're talking about deeply entrenched opinions. We're talking about emotionally charged events and rhetoric. And again, if you think about it, it's our personal belief systems, it's our upbringings. And then, of course, throw in the propaganda and, each side telling you why they're the best side and the other side is awful. And then, of course, social media gets into it. And you can get a really revved up situation where emotions can get really high. When we look at investing is structurally different, right? It's more formulaic. Yes, emotions can get in there. We have the behavioral biases that we know of. But really, it's more of a if this, then that situation, or if that, then this situation. And there's different approaches to it. You can do it from a top down or bottom up, where you're looking at the economic cycles, business cycles, profit cycles, or the reverse, starting on the ground level with the individual companies, their industries, and macroeconomics. So point here is, regardless of how you go about it with investing, it's a very disciplined kind of methodical approach. Whereas with all the emotions of politics, it already gets us stirred up and, that can impact us. So let's be careful about keeping our emotions in check.
Well, and I have to nail that, right? Because even myself, I get emotionally charged, especially in this time of the election cycle. The reality of it is that fundamentally we know that investing and politics are ultimately separate. And if you think about it, the stock market in general is actually trying to predict the future.
Right.
And a stock's price is a projection of its future earnings discounted back to today, right? So anytime we have uncertainty, right? Politics is one of them. Elections are one of them. You're going to amplify volatility, right? And the reality of it is that if we look at history and we kind of smooth this out, we know that at the end of the day, whatever the outcome of the elections, they're going to have a short-term impact on the market, both directions, right? Some good, some bad. If we look back at history on election years, we've said this many times on our monthly calls, the average performance of an election year is 11.6% per year.
It's good.
Not counting this year. And actually this year, thus far, we'll bias that up if you're just going to use the S&P as a proxy. So we know fundamentally election years in general are pretty good. Interesting thing about that stat, 70% of that return comes post-election.
That's right.
So, it's like you get a lot of chop, a lot of volatility going into the election. Then you get past it. We know the what we're going to be dealing with for the next 4 years. That's not totally fair, but we know kind of directionally policy recommendations, et cetera, for the next couple of years. And so then the markets behave based upon, now that they have the information, they know which way to go forward.
Absolutely. And, on that note, there are things we do want to pay attention to, though, right? In particular, let's get away from the headlines that, as we've discussed, can throw us in all kinds of a roller coaster.
Well, sorry, I want to dive into that real quick. Look at just what happened in July, right? The Trump assassination attempt, all of a sudden, Trump's polling numbers skyrocketed. Markets reacted to that. And then Biden withdrawing from the race and then Kamala getting the ticket, markets reacted to that. That's not normal, right? Like, that's not normal. And it was simply because Kamala's polling numbers jumped up, right?
So enthusiasm,
you know, the thing is like, well, the reality is we don't know. But it also really, it's noise in the grand scheme of things.
Yeah, and there was a bit of a Trump trade going on there, right, during that period. But, you know, getting into that topic, one thing we do want to pay attention to is the policies, right?
Sure.
So let's get away from all the other stuff, the headlines. And on the policies, there are things that we're starting to see from their economic agendas that we want to pay attention to. You know, traditionally, as it concerns markets, we look at fiscal and monetary policy. We already know the monetary policy side, that's easier. What Fed does with interest rates, you know, we can directly see how that may or may not impact the economy. Now, on the fiscal side, some of the things we're getting from their agendas, you know, number one, regardless of who it is, we're going to have to figure out the government funding situation, right? So in October will be the next date where we're going to be running out. And more than likely, given the election cycle, it's just going to be a kick the can down the road till let somebody else handle it after the elections. Regardless, then we'll have in January 1st, the debt ceiling conversation, right? So remember, again and again and again. So, and markets get past that. Let's talk about it. So that's happened multiple times, and it's now 31.4 trillion is the limit. So what are we going to do with that? And that'll be a conversation of what happens with Congress and last minute, as we've seen before in the past. But specifically talking about each candidate, right? So let's take Trump for a moment first.
Well, but real quick, let's come back to the landscape first, because everything you're saying is spot on. We know change is coming no matter what, right? I mean, we're going to have a new president regardless of outcome in November. So change is happening. But in the base landscape, the 2017 Tax Reform Act does end at the end of 2025.
Exactly.
Right. Yep. So, and what that means is that everything is going to revert back to what it was in 2017 and prior, which is lower standard deductions, the itemized deductions really materially come back. The cap that we have on state and local property taxes, that'll come back. A state tax threshold materially comes back down. And then overall progressive tax brackets move up by approximately 3%. So we know in the base, right, like change is coming because we're going to have a new president. But the reality of it is individual tax policy is also going to change December 31 of 2025. So you can anticipate that's going to be a big part of the conversation that both candidates are going to be advocating for is their
100%.
respective policies. And I think knowing that, going into it, coming back to like, how do we decipher what's fact, what's fiction, policies over fundamentals, right? Like, at the end of the day, we know that change is happening. We know what law is in place, and whatever change that each respective candidate is going to be advocating for still has to go through the legislative process, right?
And that's what ultimately markets care about most in the end, right? Is what's the overall composition of Congress. But you know, in the meantime, some of the things we're seeing is from let me also say, we're investment analysts, right? We're not political analysts, right? So I can't get into the what's exactly going to shake out and all that. But, you know, one thing that I'm paying attention to is, okay, how is it going to impact the consumer, the propensity to spend, basically? You know, the corporate tax rates, what kind of things are being mentioned there? As you mentioned, some of these things are going to be expiring. Some things are permanent, so the corporate tax right now. But Trump is talking about lowering that even more, right? So down to 15%. So that will obviously have an impact to profits. And then on the Harris side, you're seeing a lot of credits, right? It's tax credits for child tax credits. You're seeing credits for new home purchases. You're seeing incentives to build more homes for the builders. $3 million is being thrown out there. You're seeing some talk of relief potentially on small businesses.
That's 3 million homes.
3 billion homes, correct.
Yeah, not dollars.
No. Yeah, Seth, thank you. So interestingly enough, regardless of what you're looking at, it's starting to feel like a couple things are going to be just the case. Reality is more deficit.
Yep.
Right. So that impacts rates. That impacts inflation in terms of some of the propensity to spend stuff, right? But more money in people's pockets, that creates more demand. That's the inflation side. So I would anticipate likely higher inflation and rates this next several years to decade versus what we had in the past. We'll see.
But ultimately, that depends on candidate.
Regardless of candidate.
Yeah.
That's my point. So that is the kind of stuff the market's looking for to see how to, project the future in earnings. But right now, as you said, the ultimate thing is going to be, what does Congress look like?
Yeah.
Right.
Well, and let's spend a second on that, right? Like we're talking a lot about the presidential candidates, but November election impacts the House, Congress, and the White House, right?
Correct.
So the reality of it is the markets, all they want to see is checks and balances, right?
Yes.
And it's historical market environments that's all red, all blue. Those are actually the worst performing ones. And you think about it, fundamentally, coming back to the comment I made earlier, market's trying to predict the future. So as the market's trying to predict the future, by having a divided Washington, right, some combination of red and blue, that ultimately means more incremental change. Checks and balances is what we refer to. And so for 2024's outcome, as you've alluded to now a couple times, Congress is really the one that we're watching the closest, because there is a scenario here where we have a full blue wave.
Yes.
And if that's the case, from a market perspective, that would mean most likely we're going to see more broad-based change. And so we're going to get more volatility, right?
Yes.
And again, we're not political satirists, right? Like, or pundits, right? But we care about it from a market implication. What will be the environment that's going to have the best macroeconomic outcome for the markets, the economy, people, consumers, et cetera? And obviously, the media sensationalizes all of this, right? Like it's important
and that's the tough part, right?
Yeah. And I think that, the dawn of social media has just made it even worse. The divide in terms of households has gotten further and further, where you don't even want to have these conversations anymore with people. And if you do, it's typically pretty charged.
And news just travels fast. I mean, just think about it. We had an assassination attempt, and it almost feels as if it's already distant past.
Sure.
The way the media just has moved on to different things. We've had the jobs report that came out, and recession fears kind of kicked into gear, right? Which, by the way, do you need a better example that markets ultimately care about macroeconomic fundamentals?
Sure.
All the media stuff going on, political, look at what we ultimately focused on was one jobs report, right? And that kind of kicked the August sell-off. And then we got subsequent data after that that showed things are okay. Earnings are good. So on that note, there are some interesting things as it concerns election years, though, that, just kind of interesting stats out there. For one, as you mentioned, in election years, you get, 11.6% average returns. If you look at it back to 1930s, you've only had 4 negative years, right? And they were really around major events.
Great Depression. Yeah.
Exactly. World War II, tech bubble, great financial crisis. And then what's even more interesting is always leading up to the elections, you get the uncertainty, as you mentioned, and you don't know who it's going to be. But right after that, you tend to get stronger markets.
Yeah, I'll be the first to admit, August was a very surprising month for me, right? Like, I mean, when we had the market correction early on in the month, latter part of July and into August, I thought we were probably going to have a pretty squirrely summer. And to have August do, the hockey stick move like it's done, again, fundamentally, what's changed? Not a whole lot. That one jobs report number, right?
That was it.
And admittedly, this environment is unique in that it's a good news, bad news, right? And what I mean by that is bad economic data dramatically amplifies the probability the Fed's going to do some faster cuts, which the market really is addicted to that, right? And, I think we can talk about the elections as much as we want, but the conversation around the Fed right now is still going to continue to be part of the big driver for market performance. And what has been also clear with both candidates is that they've said that Powell's going to finish out his term, right? So that to me in itself means that we're going to have one less variability here, right? That we at least will have the consistency of the Fed chairman through the end of his term. Then, of course, as we kind of talk about policy decision from the Fed going forward, we know we're going to see rate cuts. Like I think we're going to see a rate cut, at least one this month. We talked about it on our calls.
100%
We might even
chance is what the markets are pricing.
Is it 100 now? Yeah, last I saw it was 98. But yeah, I mean 100 now. So we'll see a cut in September. The cynical side of me is like, of course, it's right before the election, right? But but the thing is the markets have completely priced it in, and so we shouldn't theoretically anticipate that actually would move it either direction. There's been rumblings that we might see two based upon recent jobs numbers. Yeah, I think it's going to be one, but I mean,
too speculative on that front. I think.
But I also think that we're probably looking at potentially seeing one in November and December as well now. So, and by the way, coming into 2024. The Fed indicated 3 rate cuts.
Yes.
Right?
The Fed's been actually pretty
Very consistent.
Yes.
Whole time on 3 rate cuts. It's the markets. It went from 6 to even to 0 to whatever they are now, right? The markets have been all over the place in terms of what they're anticipating the Fed to do. The point with all of this is that when it comes to investing in these types of environments, you need to follow a process. You need to be consistent 100%. And deliberate along the way. If we look at history, and we were talking about this before the call, getting ready for this podcast, if you look at history and if you invested just in a Democratic presidency, just in a Republican presidency, both have their own respective results. But if you invested the same way through all of it, your returns were significantly better. So, it's like all Republican, all Democrat, and staying invested all the way through.
And let me add on that note, remember, I'll give you 2 examples. When Trump was first running and then came into office, we had a lot of folks who were asking us, hey, should we be going in harder on energy stocks and gun stocks or getting out of the, clean energy stuff? That's the exact opposite of what you wanted to do, right? So that the former did worse, and clean energy did better. And then under Biden, all the negative rhetoric around energy, we got the same question again. Should we get out of energy because of that? And that's exactly where you want it to be, outperformed. So message here is don't get cute.
Yeah.
Just stay
deliberate, follow a process. Absolutely. Yeah. No, I mean, and the thing is the elections are going to continue to have noise. And by the way, this is future elections as well. It's not just this one. Having a discipline, having a process, following that process, I think it's imperative to place emphasis on your cash flows, especially for a retiree, have visibility on how you're going to be able to have cash flow covered for an upcoming period of time. The only guarantee we'll ever give an investor is that there will be years we lose money. That is a fact. But if you look at history, 77% of 1-year cycles probability of the S&P going up, right? So again, that's a 1-year period of time. So by the way, that's better than 50-50, right? So higher probability that the market's going to go up. But the number one amplifier to probability of success is time. The longer you give something, the higher the probability of success. So that same statistic, if you look at the S&P over a 5-year period, 97% of time, the S&P is up over a 5-year window of time, right? So again, not 100, but the point is the longer duration of time that you give something, the probability of success dramatically amplifies. And so using that as an investing thesis, it's avoid the noise. Don't let things like an election cycle impact your investment strategy or thesis. The number one destructor of long-term success with investing is emotions. Period.
Absolutely. And mind the media.
Well, you gotta, with anything, you gotta understand how a business makes money, right? And when you understand how a business makes money, you could understand what their motivation and their intent is. And the media has always been this way, right? Like they have to sensationalize fear because it's clickbait. It gets more views, right?
Market share.
And by the way, a lot of times it's not even true, right? Like, or they focus on just one piece of it that totally distorts the overall picture, right? And that's not investing either, right? Like, if anything, I use the opportunity. I mean, we've talked about this, like in August, right? When we had that correction, it's what can I buy? This was, it was like a Black Friday sale. That's the time to rebalance. That's the time to look at things like Roth conversions and get that money repositioned strategically as best you possibly can.
I think the key word there was strategic, right? So let's think longer term. Let's think strategic, and let's use these moments in the market where emotions get overreact and take full opportunity on
Bingo. Alex, thanks for the time today. This was great.
Appreciate it. This was awesome.
The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.